What are your thoughts on what we're seeing? I mean, it's my understanding you're still trying to stay on the bullish side of things, right?
Yeah, I mean, I sort of say that the Dow Jones is ensnared in a tractor beam being pulled ever closer to that 30,000 level. And really, unless we get any kind of data that knocks out the underpinnings, I think we will be reaching that level fairly soon.
And you think that the Fed sort of stays in this easy mode, right?
Exactly. Our estimate is that the Fed really doesn't do anything for all of 2020, and maybe, if anything, they'd be forced to cut rates once again. But right now, I think it's going to be lower for longer.
Mm-hmm. And when you look at all the sectors, I mean, you're saying that 10 of the 11 earnings per share of these sectors will be positive in 2020. Why is that, and what are you looking at most closely?
Well, first off, I think anything looks good. Even I look good at a distance. And so when you're dealing with 4 quarters down the road, I think analysts in general tend to be overly optimistic. History shows that 60% of the calendar year forecasts end up being too optimistic, and then they end up being brought down by a little more than 5 percentage points. So that would actually still give us a positive for 2020, but we're already seeing some of the erosion.
Okay, so that being said, staying on the positive side of things, you are leaning towards technology, towards financials. Why?
Well, I think mainly it's because we're still expecting economic growth to be fairly strong. When you look to consumer confidence, consumer sentiment came out today, which was also strong. Housing starts have been strong. I've looked at those 2 indicators, and every time since recession, since 1960, they've seen double-digit declines prior to a recession. And right now, they're showing double-digit gains.
Right. So, financials have not been performing as well as technology, obviously, but when you look at bond yields and you look at the financial group, what does it all tell you?
Well, I think what it's showing is that the momentum sort of was positive, but then has started to give back as we have found that the yield curve has narrowed once a bit, mainly because it's a lot of the regional banks that get their profits from the interest income, and it's harder to get that income when the yield curve is so narrow. So we'll have to wait and see whether it ends up being a good call or not.
Do you think Dow 30,000 this year, in 6 months? I mean,
this month,
week?
probably.
This week, I don't know. What do you think?
I think maybe a post-Valentine's gift could be Dow 30,000 in the next week or 2, mainly because it is a round number that attracts investors. But usually when we get to that level, we then end up digesting some of those gains. So I wouldn't be surprised if after we go a little bit above, sort of peek our heads above like Kilroy over a fence, then we end up sort of sliding a bit, digesting some of those gains.
Right, and I know you said to stay away from consumer staples, utilities, also U.S. dollar bullish there. On the S&P 500, what levels or range do you watch closely?
Well, first of all, discussing about staples, utilities, they've done relatively well recently because investors are leaning toward tech because they want the growth, but at the same time, they want the defensiveness and the income from utilities, et cetera. But they're trading at a 42% premium to their average PE over the last 20 years. So, basically going forward, our target is 34.35, which would imply a mid to high single-digit gain for all of 2020.
I see. So what are we leaving out here? Gold? Gold remains neutral.
Yep, gold right now remains neutral. Our expectation is that you don't really have a flight to safety scenario that's going on right now. We are seeing the dollar strengthen a little bit, which tends to be a negative for gold prices. So in general, it still appears that because of lower interest rates, that the U.S. stocks remain the preference for most investors. So
the bullishness stays here for the markets overall. We continue this up arrow. I mean, for this week, the Nasdaq's up over 2%. As a matter of fact, all the major averages are higher. When we look at what's going on here, are you just not as worried about coronavirus or Boeing or all these things sort of, spooking the market?
Not as worried, but I do acknowledge that volatility is likely to be higher this year. I say that because if you're a believer in the January barometer, as goes January, so goes the year.
Right.
Whenever the market was down in January, as it was this year, volatility was 40% higher in those years versus whenever the market was higher in January. The volatility I'm talking about is the number of days in which we were up or down by 1% or more in the S&P 500.
But, so you're not saying we're down for the year, you're just saying volatility for the year.
Exactly. I still think we're going to be up for the year, but it's going to be a bit of a bumpy ride.
So when we invest in technology, you mentioned technology and financials. Can you be a little more specific within technology? What are you really looking at as maybe potential leaders in the group?
Well, we just heard about NVIDIA, some of the semiconductor stocks, semiconductor hardware, semiconductors themselves are showing better than expected earnings, semiconductors being less negative, if you will, whereas the semiconductor equipment showing an improvement from a positive perspective. So, in general, technology, we think, will be the leader.
Yeah, when we look at the groups, what's happening today, real estate, utilities, and technology and consumer staples, American Express, Visa, Home Depot, those are some of the best performers today. What do you see in the market when you see what's leading today?
Well, what I see is a bifurcation. We see that people are saying, yes, I do want to go for growth. I do want to go for consumer cyclicals such as Home Depot. I do want to go for technology, but I'm going to hedge my bet. I'm going to then also show preference toward utilities and real estate because I want the income. With the 10-year note being below 2%, investors are saying, I need that income.
Right, because it's strange to see utilities and technology being the leader. That was why I asked you the question, because that's sort of what we've seen with what's going on in the markets. People want the risk, so they go into equities, but we've seen bond yields lower. I mean, not necessarily one day.
Well, going back more than 65, more than 65 years. Whenever the dividend yield on the S&P 500 has exceeded the yield on the 10-year note, equities were higher by an average of 18% 12 months later because investors are saying, I got nowhere else to go.